Stock markets in the cities of Shanghai and Shenzhen were suspended Monday after falling more than 7% on the opening trading day of 2016. The sell-off triggered the Chinese government's so-called circuit breaker mechanism for the first time, a system designed to prevent volatility by halting trades.
I'm
in favor of the circuit breaker mechanism, but the government implemented it on the first day. It's kind of like testing the market.
It's the millions of Chinese investors like Mr. Wu, many of them pensioners, that drive volatility, says analyst John Driffel of Birkbeck College, University of London.
The Chinese stock market is populated by a large number of small investors who are very prone to panics and booms and crashes. They're exchanging information and rumours. These are stock market players with a very short-term perspective. They're gambling with small amounts of life savings.
The falls were driven by a survey showing that activity in Chinese factories contracted for the 10th straight month in December and at a sharper pace than in November.
It's just renewed the same fears that dogged a lot of last year's trading, namely that the slowdown in China's economy could be set to speed up.
Those fears were echoed in European and US markets, which saw declines of several percent. Figures due out later this year are expected to show that China posted its weakest economic growth for 25 years in 2015, slipping to around 7%. But that's a natural consequence of China's rebalancing economy, says Driffel.
The rapid economic growth of China was always going to be a temporary, perhaps a medium-term phenomenon, but not a permanent phenomenon. I mean, when China approaches the level of real incomes per head or productivity per head of developed economies, it's going to grow at the same speed.
Analysts say concerns over worsening tensions between Saudi Arabia and Iran are also weighing on stock markets and driving up the price of oil. Henry Ridgwell for VOA News, London.